Now for a look at the bigger picture. Joining me right now here in person, David Stryzewski's with us, CEO, Sound Planning Group. Thank you for being here.
Pleasure to be with you.
You know, I think that there are a lot of people who are chasing the rally. And even JP Morgan came out and sort of gave a little bit of a warning. And you, by the way, you're similar to what something they like too. They were saying get gold, you know, in gold and cash because the rally may not last, right? What are you thinking here?
Okay, so, I mean, here's a couple things that are real. One, we just ended the longest bull market in the world's history. Second, Fed just flipped interest rates. We now have the fastest rate increase in the history of the United States. And that really just flipped the market upside down. So everything's kind of in turmoil right now. We've rallied 3 times based upon this idea of pause and pivot. And you know, the market's obviously priced that in. I think that we're going to be higher for longer. And because this recession is showing up likely within the next quarter here, I don't know that we're going to get to this point of pause and pivot. Therefore, it could be pretty challenging for those that have this Goldilocks theme of the splashless landing. So yeah, I think that that we're going to see a lot more volatility in the future, and that we need to be really considering, you know, what are our options and ideas.
I mean, gone are the days of the secular bull market and taking a pause. I guess you really feel that now is a time to be a little more cautious. As a matter of fact, as everybody's waiting for a recession, you've had some advice for that as well. I mean, what are your thoughts on a recession and how to hedge against the possibility of a pullback here?
Sure. So, you know, we have to understand risk tolerance for a minute. And so those who got stock and risk on assets, and then we got more I know so money, which are our bonds or fixed assets. Now, here's one big challenge for those, specifically because my firm works with those that are entering or nearing retirement. A lot of them are just loading up on bonds right now. And I just want to put a big caution on that just for a second to consider. And that is one of the big issues right now with the banks is that interest rates rose so much the value of those bonds went down. And so it's the seesaw effect. And that's just one of 5 ways that bonds can lose money. Another way that bonds can lose money is, well, it's kind of the same thing that happened in 2011 in the United States. We were AAA rated, went to AA rated. There's a lot of corporations today that need more money to continue to go on than they can just, you know, putting cash out there and working out. So let's say that they get a downgrade, that could be a big challenge here for those that are looking at this. So how do we hedge today? Simplest answer that I have for you is that there's never been a better time to own something called a growth-oriented fixed indexed annuity. It's an insurance product. Now these give us none of the downside, reasonable rates of return on the upside of an index, and they can work out really well. But more importantly, they give us some liquidity that when the market does go on sale, that we can dollar cost average back in. And so I love that opportunity. I love that play, especially for those that are no longer contributing to their accounts.
Okay, so that makes sense because, as you said, everybody's been piling in to T-bills. You also were looking at some of the precious metals, right?
That's right. So gold and silver are important. Now, the reason why I specifically emphasize silver is that we're looking at an 83-to-1 ratio. I mean, give me 83 silver for every 1 ounce of gold, I'll do that deal all day. And the reason behind it is 9 ounces of silver can be mined for every 1 ounce of gold. And so that's an incredible arbitrage with the numbers right there. So I think that that's a really important idea for people to be paying attention to.
Yeah, understood. In the meantime, as we talk about some of the wild cards and what's going on here, debt ceiling, you're less worried about the debt ceiling. You really feel that they'll get that done.
Well, I do think they're going to get it done, but it comes down to, can they get spending cuts and not just tax increases? We've got enough tax revenue coming in right now. In fact, record tax revenue. So I think that they will get something done, but there could be a hiccup next week if they don't.
Yeah, and you don't want to see it just, you want to see some spending cuts as well, because that's the big picture too.
That's right.
That being said, talk about some of the other things. I mean, as you mentioned, some of the companies that are up against the wall. You even said Chapter 11 likely for a lot of companies. We saw that during COVID, post-COVID, even the ones that got back on their feet, then they had the Omicron variant and couldn't do it. It's just one more straw on the camel's back and it's over.
Yeah, and so I think about the small and local regional banks. Okay, 70% of all lending to corporations, whether it's their real estate, which office space is in big trouble, or those specific organizations, they're going to have a hard time finding banks to lend to them on a 10-to-1 basis when all those banks no longer have capital because everyone put them into the too big to fail banks, or they put them into treasuries. And so I think a lot of Chapter 11s could be unfolding over the next few years, and I don't think that this is just going to be some quick downturn recession. I think it's going to actually unfold as a rolling recession over time.
So does that fit into your mantra as to and why now is not a good time to buy a house?
Yeah. So the idea about a house is, date the rate, marry the house is the thing that a lot of realtors are saying. So marry the house, okay. Well, date the rate, yeah, rates will come down, but what if the price of the house also comes down?
Right.
Then you go to refi.
Because if you have a recession or that kind of environment, all these houses that ran up, I mean, things are coming down.
Yes. But what happens if you got a 20% pullback? You got to come to the table with 20% cash to close that mortgage deal, to refi at a lower rate. That's not going to work out.
Right.
A lot of people going in interest-only loans right now. Big concerns about that. I see and expect a big recession or a pullback here on real estate for the personal side, but the biggest move is going to be in office space.
Right.
Because people are working from home right now. Businesses are having to right-size their how much office space that they're holding on to.
And that's the concern. I mean, there's been a lot of talk about commercial real estate, and the question was, is it really, really a concern? And it's sounding like, at least in office space in particular, some of those loans are coming due.
Yes.
That it truly is. I mean, that's one of the reasons why PacWest is doing so well today. Mm-hmm. They sold off some of the real estate portfolio.
Yeah, they have to metabolize $1.4 trillion in corporate debt in 2023 and 24. That's a record amount of debt coming due all at once at a time when credit crunches are occurring in those banks that specifically do that.
Yeah. Just quickly, cash.
Yeah.
What are your thoughts on cash at this point?
I like cash. It's a real position. Of course, it's hard to get out of cash and back in because people kind of just don't know when to get back in. So dollar cost averaging is the message to be able to share.
Right, but there's no bull here.
No.
That's for sure. All right. Thank you so much, David Stryzewski. Thank you for being here as CEO of Sound Planning Group. Thank you, David. Still ahead, we're going to take a look at Dick's